Hello. Yes, good afternoon, everybody. I hope you can hear my voice and at the same time see my screen clearly. So today's webinar, I want us to look at a topic which we've looked at in the past. I think there was a time we basically focused so much on it. We were looking at how to trade correlation, and there are a lot of things that we looked at that time. Today, I want us to revisit the same thing. I want us to see exactly how to do certain things, how to trade correlation, and what correlation actually means. So in my own definition, correlation is basically when several instruments having the same base currency or same quote currency suddenly begins to do the same thing. That is when you have several instruments, like when you come here to the market here, there is Euro USD, so all of them will have something like this. We have Canadian dollar versus Swiss franc. We have Canadian dollar versus Japanese yen, and then we have Swiss franc versus Japanese yen. Then we have Euro versus Australian dollar, Euro versus Canadian dollar, Euro versus Swiss franc, Euro versus pound, then Euro versus Hong Kong dollar, and Euro versus Indian rupee, and Euro versus this and this. So what correlation simply means is when the market suddenly does the same thing across several pairs with the same base currency or the same quote currency. So if you're that person who is trading just one instrument, maybe you're trading, you say, okay, you'll be trading strictly gold, and you specialize completely on gold. The thing is, you'll become a master when it comes to trading gold. But what will happen is this, that you'll be missing a big chunk of the market out of your strategy. So you'll find yourself at the point where you do have a lot of trades on one instrument. Some are winning, some are losing, but you don't understand exactly what is happening across the board. Like when I say across the board, I mean on other instruments that should be doing the same thing as the one which you're trading. So that is exactly what I want us to look at today. We want to break down the whole thing. I want us to look at the best way to trade correlation and how to ensure that you are entering trades consistently in a manner that you are profitable at the end of it all. So let me put my charts. Let me add my charts on the screen so that I will attach this Euro AUD. Then I'll also attach Euro Canadian dollar. And then I'll also attach Euro versus Swiss franc. Then I'll also attach Euro versus the British pound. And then I'll also attach Euro versus the Japanese yen. Then put them on my screen so that you're able to see exactly what I'm going to at. So look at these charts properly. Let me remove this. Look at these charts. Look at what's happening on these charts. I have three pairs that have the same base currency but different quote currencies. So look at what has been happening on these three charts. If you take, leave this chart alone, this one. So look at what has been happening in these charts. Look at what has been happening. See that from this day, this is 3rd of October. This is 3rd of October. This is 3rd of, except for this one, which gave a different move. You can see that on this day, on this given day, the price actually moved up from the opening of the day, continued upwards, then it came down, then it pulled back up, then it went down, then it went up, went down. Currently, it's going upwards. If you check this one, it started by going the opposite. It went down completely, and then it continued up, then it went down, and it went up. This one here from the 3rd of October, it went up, 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 came down, continued up, came down, continued upwards. So what happens, this may not necessarily be the best example of correlation because at the moment they're not giving us correlation. So as I mentioned at the start, correlation is when several instruments are giving you the same signal. So if the market suddenly begins to give you the same signal across the board, then you know that those given currency pairs, they are positively correlated. But if they are showing you different signals, or some are showing you the same signals, some are showing you opposite signals, then just know that they are negatively correlated. The ones that are moving opposite the others are negatively correlated to the ones that are moving in the same direction. So the ones that are moving in the same direction are positive correlated. Those that are moving in the opposite direction, they are negatively correlated. So how do you trade correlation? So I want to add another pair. I'll add UD USD just for the sake of understanding. USD. This I'm adding these two pairs because they are related. When you see a signal on NZD USD, answer this same signal on AUD USD. That's why I'm using them. So look at what happened here. We take this high, then we draw a line along it, pick it, and then draw a line. When we come to this point, we do the same thing. See that there's a line. So when this was giving us this high here, this was also giving us this high. Then when the price came back and it was touching this level here, look at what is happening. Almost around the same time when this was happening, also the same time when so this was at 11,026. I see. Almost at the same time. Listen, almost at the same time when the price for NZD had gone back and touching this level here. This was here, and it was actually reversing in the direction. So how could you have used this information to your advantage so that you know exactly when to trade, when to enter, when not to enter trade? It is very simple. When this is here, the price has gone down, this has come back, it's touching this level while this is not touching that level. This is known as divergence. Divergence is when the price is doing opposite. But this case, we are looking at two instruments that are always positive correlated when they're giving us something exactly opposite. And that's when you enter position. So you'll find yourself at that point where we'll enter a sell here because this has reached the peak. This level here, I'll call it overbought area. Overbought to mean that the price actually went up, got exhausted. Same thing happened here. So we had here exhaustion. When the price came back, we were expecting same exhaustion, but this one here exhausted a bit earlier. So this is where you could have taken the sell trade. Technically speaking, this is where you could have taken a very good sell position here. You have your stop loss at the peak of this candle here. You do the same thing here. So when you enter such a position, the question comes in, how do you know exactly when to step out of the trade? So look for the same thing which you just looked at now in the opposite direction. Look for a divergence which indicates a buy, and then you step out of the sell which you had previously. So if you had like a you had like a sell here, have a sell here, wait for that case. Like here, how I'll get out is this. I will say, okay, this is another peak. This is another peak. So I drew my line there. Then this was also another peak. From this peak, from this peak, this peak, those are inverted peaks. This. So I now say, okay, I've entered a sell here. At the same time, I've entered a sell here. My expectation is that the price is going to continue down. It likely go and touch this level here. So what you do is this. If the price goes and touches this exhaustion, like it did at this point here, you step out of both those trades. So you'll step out of the sell which you had previously from this point, and the sell which you had for previous from this point, and that could coincide with this point. So when you will be stepping out here, because this will be showing you exhaustion, it's the same time that you step out of that buy because of the exhaustion that you're having somewhere here. Are we on the same page? We should be same page. So what we'll do is this. Now we've entered, we've stepped out of a position. Yeah, stepped out of a position. We took a sell because there was this divergence. The divergence was happening because of this space here. So this is what was left for price to hit this point before the other chart can also follow suit. So this is too big, and we were not expecting the price was actually going to meet it. And if that was the case, then it means that this also could have gone upwards. But the distance is too big. That is why it could not go up to that point. So it had no otherwise but just pull back. And when you enter the sell position here, you're not entering the sell position because of this chart alone. You are entering sell because on the other instrument, we are seeing the same exhaustion. The price has moved upwards and it has reached a point of buyers are exhausted. Expect the price to continue down. So here, now this is exhausted first. When we are getting out, it is the other one which is now getting exhausted first because the price has gone up to the previous lowest low and it has exhausted. So we have to step out, and we step out on everything. Now, something else. Let's remove these lines. Moved all those lines. Also remove this. So now, assuming I want to trade, I'm doing my own analysis right now, and I want to know exactly where the price may likely be going up to, what will happen in the next few hours. So what I'll do is very simple. Very, very simple. I'll pick the high. I'll pick this one. This is like the bottom exhaustion. I'll pick it. Put a line below it, and then I'll also come and pick this exhaustion. Yeah. Now we have two exhaustions. We have this one, we have these ones. Both of them were happening at the same time. And I come and now draw a line here. This line is to mark point where we had the exhaustion. Next chart, we do the same thing. So now I want you to look at something here. Look at the distance. That we have between this point and the other one is already below the same level. It means there's a reversal that is imminent. There is a reversal that is imminent. And what that means is we are expecting that at some point on NZD-USD, the buyers may come in and push price to the upper side. And also in the very near future, we don't expect that the sellers will push price up to this point. We instead expect that the buyers will come in, push price upwards, most likely up to this point here. The other one up to on the same level, this one. 0.59290, 0.63923. So we are going to expect that the price may likely reverse on this one to the upper side, and it's likely to reverse because of this gap here. We are trading, we are somehow combining correlation. We are trying to combine correlation with the divergence. So all those names, they're just fancy names. I would refer to them as opposite. So I would say, okay, this is moving opposite the other one. When they're positive correlated, they are opposite. When they're negatively correlated, when they're moving, when we expect them to move together but they're not doing the same thing, we say they're divergent. So this is how you can use correlation to trade. Things have all been giving you the same signal. Then suddenly you an opposite signal on one of them. Just know the other one will follow the suit very soon. So the other one will follow the suit very soon. So like this is now downwards. It has gone some pips below this level here, but this has not done the same thing. It is possible. It is very, very possible. It is very, very possible that this one will not fill this gap. Let it just continue to the upper side. And when that happens, we'll be focusing strictly on buy positions. We don't know what happens. We don't know what happens. All we know is these two instruments are supposed to be moving in the same direction. So when they don't move in the same direction, say they move to the opposite direction, then we look for a trade that matches that opposite, the opposite to the opposite of what's happening. So let me explain that on the real chart so that you understand what I'm saying. Like here, we are seeing a downtrend. We are seeing the same downtrend here. But since this has not filled this gap, but this has filled the same gap, chances are that it's going to reverse upwards. And it could happen like this. Let me explain what I'm saying. It could happen like this. This chart may go and fill this gap, but at the same time, likely to see a retracement on NZD-USD, which will only go up to this point here. So the best time to look for a sell on this chart will be when AUD-USD is touching 0.63923. We'll be touching here. And at the same time, NZD-USD is touching 0.58826. Then this will be the correct place to look for sell from. This will be the most ideal place that we will recommend that focus on sell position. So right now, as I'm speaking, you may be a bit jittery to pick buy position or sell positions. The best thing is simply to wait and see what happens. Wait and see what happens. If the price pulls back, and touches this line 0.63923, and at the same time, NZD-USD is touching 0.58826, then this right here will be the ideal place to look for a sell for. Don't be afraid. Just enter the sell position here. Have your stop loss above the high of this candle. Enter your sell position here. Have your stop loss a few pips away from that candle, and have your take profit here where we have the low. Also, this one, when you enter the sell, have your take here. So when the price hits, or if it goes up to this point, you can step out on both of them because this is an exhaustion level. We have already gone below this. So when this is exhausted, we expect the other one also to be exhausted. That is the best way. That is the best way to enter session. I know most of us thinking about some indicators, how to add some indicators for negative correlation, or for maybe for divergence or convergence. But the best way to look at those two is when prices are actually showing us opposite thing. One more thing, I'm not saying that indicators are bad or that you do not follow indicators. No, indicators are built from prices. Just that in our case here with this example, we are actually just looking at prices and adding just one indicator, which is a zigzag indicator, and we are trying to explain exactly how to use it to our advantage so that we can get more out of it. That is what we've just looked at the moment. So I think that should make a good sense. And one more thing is you can, if you're somebody practicing how to master correlation and don't know exactly how to do it, just look for pairs that have the same base currency, line them up together, and then have an indicator, just even a moving average. Attach the same moving average, the same period, the same settings on all those charts. Wait for the same thing to happen across the board, and then you trade exactly that. You may wait for maybe when the price breaks below the moving average on all those pairs, then you enter position on all of them at once, and then you step out also once. If you do that, you practice that, and you're entering 10 trades, and you step out after maybe 2 pips, 3 pips, you'll find that out of those 10 trades, you have like 30 pips in profit almost instantly. The good news is you'll be earning them, and if one loses, the others which wins will cover it up. And one thing, avoid trading just avoid cases where you make decisions based on just one instrument. Avoid completely. So avoid cases where you find yourself entering trades based on just one thing. Look at these two instruments, look at the way they look similar. If you check your charts properly, you'll see in the past that they have been doing the same thing for years now. So that is when you're supposed to be trading. Not when what you want is happening. You trade when what the market is doing, you understand it. Does that make sense? So that should basically bring us to the end of this analysis. We're going to meet again next week at the same time. Thank you.